Welcome. Aware. Andao. Dumalang. Molo. Sobona. Condit. And a warm welcome to the Enduo Knowledge Cast, the podcast where your curiosity meets insightful conversations. Today, we're diving deep into IFRS 2, share-based payment. You know, that accounting standard, that can sometimes feel like trying to find your way out of a crowded taxi rank.
It can definitely feel that way sometimes. But don't worry, we're here to navigate the ins and outs of IFRS 2, making it as clear as a sunny day in the Karoo.
That's reassuring. Because let's face it, share-based payments are a big deal here in South Africa. From the up-and-coming entrepreneur trying to attract top talent to the established companies looking to retain their best people. Everyone seems to be using share options or other share-based incentives these days.
Absolutely. And for good reason. Share-based payments can be a win-win for both companies and employees. Companies can attract and motivate talent without immediately impacting their cash flow, while employees get the chance to share in the company's success. But as with any financial arrangement, there needs to be a set of rules to ensure fairness and transparency. That's where IFRS 2 comes into play.
Okay, so IFRS 2 is like the referee on the rugby field, making sure everyone's playing by the rules.
That's a great analogy. IFRS 2 sets the standard for how companies should account for share-based payments to ensure that their financial statements provide a true and fair view of their performance. It doesn't matter if the company is giving out shares, options, or even cash bonuses tied to the share price. IFRS 2 has got it covered.
Now, before we get lost in the technical jungle, let's start with the basics. What exactly are we talking about when we say share-based payment? I'm imagining something a bit more sophisticated than just handing out a few shares to employees.
You're right, there's more to it than meets the eye. A share-based payment arrangement is essentially a deal between a company and an employee, or sometimes another party, like a supplier. The company promises to give the employee something of value, typically shares or options. But there's usually a catch.
There's always a catch.
Of course. It's not just a freebie. These shares or options typically come with conditions, known as vesting conditions, that the employee has to meet before they can actually get their hands on those rewards.
Vesting conditions. Huh. Sounds a bit like those loyalty programs at the supermarket, where you have to spend a certain amount to earn points. What are some common types of vesting conditions?
Well, one of the most common ones is a service condition, which basically means the employee has to stick around for a certain period. Think of it like a probation period, but with the added bonus of potentially owning a piece of the company down the line.
So that's saying, show us you're committed, and we'll share the spoils of our success. What other types of vesting conditions are there?
Another common type is a performance condition. This one's a bit more challenging. Instead of just showing up for work every day, the employee has to help the company achieve certain performance targets.
So it's not just about clocking in and out. You actually have to contribute to the company's growth to reap the rewards. It's like scoring a try in a rugby match. You have to put in the effort to get those points on the board.
Exactly. These performance targets could be anything from hitting a specific revenue goal to launching a new product, or even achieving a certain level of customer satisfaction. The key is that the employee's reward is linked to the company's performance.
Okay, I'm starting to get the hang of this. So we've got these share-based payment arrangements with vesting conditions that add a bit of spice to the mix. But before we go any further, let's break down some of the jargon. What exactly is the grant date in this whole process?
The grant date is a crucial milestone in the share-based payment journey. It's the day the company and the employee formally agree on the terms of the arrangement. Sort of like signing a contract. Think of it like the official kickoff of a rugby match. From this point on, the clock is ticking and the game is on.
And once that grant date whistle blows, we need to figure out what those shares or options are actually worth.
Right.
That's where the concept of fair value comes into play.
You got it. Fair value is all about figuring out the price that a willing buyer and seller would agree on for those shares or options on that grant date. It's like going to a market in Durban and haggling for the best price on a beautiful Zulu basket. You have to consider all the factors that might influence the price.
So anything that it's not just about what the company thinks those shares or options are worth. We have to consider market conditions, the company's prospects, and even factors like future dividends. It's like trying to predict the unpredictable South African weather.
Well said. Determining fair value often involves using valuation models and considering various factors, such as the current share price, expected volatility, and even the likelihood that the employee will actually meet those vesting conditions.
That makes sense.
Yeah.
So we've got our grant date, and we figured out the fair value. Now, Let's talk about the different types of share-based payments. I've heard the terms equity settled and cash settled thrown around. What's the difference?
That's a key distinction to understand. With equity settled arrangements, the company ultimately settles its obligation by giving the employee actual shares or options. It's like giving them a slice of the company pie. On the other hand, with cash settled arrangements, the company promises to pay the employee a cash bonus linked to the share price.
It's like betting on a winning horse. If the share price goes up, the employee gets a bigger payout.
Yeah.
If the share price tanks, well, they might be left with a smaller bonus than they hoped for.
That's a good way to put it. And each of these arrangements has its own unique accounting implications, which we'll delve into a bit later.
This is all starting to make sense now. So
No, babe.
we've got the basics down. Share-based payments, vesting conditions, grant date, fair value, and the different types of arrangements. But how does IFRS 2 actually tell us to record all of this in the company's books?
That's where the real fun begins, and that's what we'll be unpacking next time.
Sounds good. I'm looking forward to it. See you then.
Welcome back to the Endure Knowledge Cast. Before the break, we were about to unravel the mystery of how IFRS 2 guides companies in recording these share-based payment transactions. It's like assembling a puzzle, where each piece represents a different aspect of the accounting process.
I love a good puzzle. So where do we even begin with this IFRS 2 puzzle?
Well, let's start with those equity-settled arrangements. Remember, those are the ones where the company gives the employee actual shares or options.
Not the piece of the pie scenario.
Exactly. IFRS 2 says we need to measure these arrangements at their fair value on that all-important grant date. But there's a twist. We also have to consider the possibility that some employees might not stick around long enough to actually receive those shares or options.
The vesting conditions coming back to haunt us. Not everyone is going to make it through that probation period or hit those performance targets. It's like a wildlife documentary where only the strongest survive.
A very apt comparison. We call this the vesting requirement. And it essentially means we need to estimate how many of those shares or options we actually expect to vest based on historical data and other relevant factors.
So it's like being a game ranger, trying to predict how many animals will survive the dry season.
You could say that. We adjust the expense associated with the share-based payment based on this estimated vesting. This ensures that the company's financial statements reflect a realistic cost, not just the maximum potential cost if everyone stayed and achieved every target.
That makes sense. It's like budgeting for a braai. You don't buy enough meat for the entire neighborhood just in case everyone shows up.
Yeah.
So how does IFRS 2 tell us to handle those cash-settled arrangements, the ones where the company promises a cash bonus tied to the share price?
Cash-settled arrangements bring their own set of complexities to the table. Instead of recording an expense based on fair value at the grant date, like we do with equity-settled arrangements, IFRS 2 says we need to recognize a liability. A liability. So it's like the company is taking out a loan. But instead of paying back the bank, they're potentially paying their employees.
That's a great way to think about it. This liability represents the company's obligation to pay that cash bonus, and it gets recorded on the balance sheet. But here's the kicker. Because the share price can be as unpredictable as a taxi driver in rush hour, we have to remeasure this liability each reporting period.
Oh boy. That sounds like a recipe for some serious accounting headaches.
It can certainly keep accountants on their toes. The liability goes up if the share price rises, increasing the potential payout to employees. Conversely, if the share price takes a nosedive, the liability decreases.
It's like a financial bungee jump, constantly going up and down as the share price fluctuates.
That's a very vivid image. But that's why IFRS 2 is so important. It ensures that companies are constantly monitoring and adjusting their financial statements to reflect the changing value of these cash-settled arrangements. It's all about keeping those financial statements accurate and up to date, like a well-maintained set of traffic lights, ensuring a smooth flow of information. Now, I know we have to talk about one of the more intricate aspects of IFRS 2, modifications. What happens when companies decide to change the terms of those share-based payment arrangements after they've already been granted?
Modifications are like adding an unexpected detour to our road trip. They can happen for various reasons, sometimes to sweeten the deal for employees or to adjust for changing market conditions.
See, it's like deciding to stop for a delicious bunny chow in Durban on the way to Cape Town, even though it wasn't part of the original plan.
Exactly. And just like that unexpected bunny chow stop can affect your travel time and budget, modifications can have significant accounting implications. IFRS 2 provides specific guidance on how to account for these modifications, ensuring that any changes that benefit the employee are properly reflected in the company's financial statements.
Can you give us an example of a modification that would benefit the employee? Something that would make them say, show, that's a lekker deal.
Let's say a company had initially granted share options to its employees with an exercise price of R10 per share, but the market takes off, and the company's share price skyrockets to R20.
Those employees are probably feeling pretty chuffed right about now.
They might be tempted to exercise their options and make a quick profit, but the company decides to sweeten the deal even further by lowering the exercise price to R5 per share.
Wow. It's like getting a 2-for-1 deal on your favorite biltong.
Exactly. And IFRS 2 says that the company needs to recognize an additional expense to account for this benefit to the employee. It's all about fairness and transparency, making sure that those financial statements tell the whole story.
Makes sense. Now, what about those modifications that make things a bit tougher for the employee? Are those even allowed?
IFRS 2 is generally quite strict about companies trying to backtrack and make things harder for employees after the grant date. For example, let's say the company wants to extend the vesting period, making employees wait even longer to get their hands on those shares or options. IFRS 2 basically says, nope, you can't pull a U-turn like that.
So, it's like trying to reverse on a one-way street. Not going to happen. IFRS 2 protects the employee from those sneaky maneuvers. Now, before we move on to our final part, let's talk about group transactions. These are like those family gatherings where things can get a bit complicated.
Group transactions can definitely be a bit more challenging, like trying to figure out who's bringing what to the braai. Imagine a scenario where a parent company grants share options to employees of its subsidiary. Now, whose financial statement should reflect those options? The parents, the subsidiaries, or both?
That's where things start to get as tangled as a plate of spaghetti.
Oh. IFRS 2 provides guidance on how to untangle those noodles. It helps companies determine whether to treat those transactions as equity settled or cash settled, and provides guidance on how to record those associated expenses and liabilities. The key is to ensure consistency and transparency across the entire group structure.
It's like having a designated driver for those family gatherings, someone to keep things in order and make sure everyone gets home safely.
But hold on, we were just talking about how equity-settled transactions are measured at fair value on that grant date. Does that still apply when we're talking about group transactions?
That's a great question, and a perfect example of how those group transactions can throw a spanner in the works. What if the parent company's shares are listed on the JSE, but the subsidiary is a private company?
That does complicate things. How do you determine fair value when there's no readily available market price?
Well,
Yeah.
IFRS 2 allows for some flexibility in these situations. The subsidiary might have to look to other valuation methods, like a discounted cash flow analysis or comparing itself to similar publicly traded companies. It's like trying to find the perfect match for your shui outfit. You have to explore different options to find the best fit.
So, it's a bit like being a detective, searching for clues and using all the tools at our disposal to get to the bottom of those group transactions. But that's a story for another time. We've covered a lot of ground today, from the basics of share-based payments to the complexities of group transactions. But before we wrap things up, we have to talk about a crucial aspect of IFRS 2, disclosure, after all. Transparency is key, especially in the world of accounting.
Absolutely. Join us next time as we shine a light on the disclosure requirements of IFRS 2 and explore how these requirements help to ensure that everyone has access to the information they need to make informed decisions.
Welcome back to the Indufo KnowledgeCast. For the final leg of our IFRS 2 journey, we've explored the nuts and bolts of this accounting standard, tackled those tricky group transactions. And now, as we reach the summit of our deep dive, it's time to reflect on the bigger picture.
It's a bit like reaching the top of Table Mountain and taking in those breathtaking views. We've climbed through the technical details, and now we can appreciate the impact of IFRS 2 on the financial landscape. I like that analogy. So, let's talk about disclosure. Why is it so crucial when it comes to IFRS 2?
Transparency is the name of the game in accounting, and IFRS 2 takes that very seriously. It requires companies to lay all their cards on the table. When it comes to share-based payment arrangements, think of it like a braai where everyone brings their best dish to share. No hidden ingredients.
So, it's all about giving investors and analysts a clear view of what's cooking in the company's financial kitchen.
Precisely. IFRS 2 demands that companies disclose a whole smorgasbord of details, starting with how they valued those share-based payments. Remember those valuation models we talked about? Companies need to explain their methodology, what assumptions they made, and even the potential for those valuations to change.
It's like showing your work on a maths exam. You can't just ring down the answer. You have to demonstrate how you got there.
Exactly. And the disclosures don't stop there. Companies also need to reveal the expense they incurred for those share-based payments, provide detailed information about the types of share options granted, and even break down those vesting conditions.
So, it's like a detailed recipe, listing all the ingredients and instructions so anyone can recreate the dish. Or in this case, understand the impact of those share-based payments.
Well said. And remember, those group transactions we discussed, IFRS 2 demands even more transparency there. Companies need to disclose which entities are involved, how those transactions were structured, and how they determined the accounting treatment.
It's like those intricate beadwork patterns, where every bead has its place and contributes to the overall design. IFRS 2 ensures that all those beads of information are meticulously laid out for everyone to see.
And all of this disclosure serves a vital purpose. It allows investors, analysts, and even employees to assess the true cost of those share-based payments, understand their potential impact on the company's financial performance, and even evaluate the fairness of executive compensation.
It's not just about ticking boxes and complying with regulations. It's about empowering stakeholders with the information they need to make informed decisions.
Absolutely. IFRS 2 aims to create a level playing field, ensuring that everyone has access to the same information and can draw their own conclusions.
Now, as we wrap up our deep dive, I can't help but wonder if IFRS 2 truly achieves its goal of preventing creative accounting. Are there any potential loopholes that companies might try to exploit?
And that's a question that keeps accounting experts and regulators up at night. While IFRS 2 has come a long way in standardizing the accounting for share-based payments, there's always the potential for those who try to bend the rules.
It's like those crafty baboons you see at Cape Point, always looking for an opportunity to snatch a tasty snack.
A very fitting image. One area where we see some potential for gamesmanship is in those valuation models. Estimating fair value can involve a lot of subjective judgments, and there's always a risk that companies might try to tweak those assumptions to paint a rosier picture of their financials.
So, it's like trying to guess the weight of a watermelon at a farmer's market. You can poke and prod all you want, but there's always an element of uncertainty.
Exactly. That's why it's crucial for auditors and regulators to be vigilant, scrutinizing those valuations carefully and challenging companies to justify their choices.
It's like those sharp-eyed meerkats, always on the lookout for danger.
Precisely. Another potential loophole lies in those complex group transactions with multiple entities involved and different valuation methods at play. There's more room for creative structuring and accounting choices that might obscure the true economic substance.
It's like navigating a crowded taxi rank, trying to find your way through a maze of routes and fares.
Well said. That's why transparency is paramount in these situations. IFR 2 requires extensive disclosures, but it's up to investors and analysts to dig deeper, ask the right questions, and connect the dots to get a complete picture.
It's like assembling a puzzle, where each piece of information, no matter how small, contributes to the overall image.
That's the beauty of IFRS 2. It provides the framework. But it's up to us to use our critical thinking skills and financial savvy to interpret those disclosures and draw our own conclusions.
So, as we bid farewell to IFRS 2, let's remember that this accounting standard is not just a set of rules. It's a dynamic framework that's constantly evolving. To keep pace with the ever-changing world of business, it's up to all of us to stay informed, ask tough questions, and hold companies accountable for transparent and accurate reporting.
Well said. Understanding IFRS 2 is an ongoing journey, not a destination. It's about developing a critical mindset, embracing transparency, and using our knowledge to make informed decisions.
And on that note, we've reached the end of our IFRS 2 safari. We hope you've enjoyed the ride and gained some valuable insights along the way.
It's been a pleasure sharing this journey with you. Until next time, stay curious, keep learning, and may your financial adventures be filled with clarity and understanding.
This has been the Induvo Knowledge Cast, the podcast where your curiosity meets insightful conversations.